So the number one thing that high net worth and accredited investors come to us for is how they have questions around how they can reduce their tax position. They pay a godly amount of income tax. It is by far the number one expense that high income earners and accredited investors have in their lives. And they want to do everything they can to, within their power and within the letter of the law to reduce their tax position. So what we want to do is outline, we've talked about this in the past, but we want to outline a very, very effective strategy that uses a flow-through share offering that's provided to a client. So they actually would invest in this offering. Now, it's not done through ourselves personally, but it's partnered with different firms across Canada that facilitate these transactions. But it's something important from a planning perspective that we want to introduce. And so what it does is it invests in a flow-through share security, which by definition, what a flow-through share security is it's often a junior resource or exploration company that does not have income, but has a tremendous amount of expenses because it's a new company or a new initiative. And the government allows them to flow the tax credits or flow the deductions that they would normally have to the investor so that they can benefit from the tax savings from those expenses. And more often than not, you would have to invest in these as an investor, and you would be exposed to the risk of that security, which, as I mentioned, they're junior resource, they're highly speculative. Quite often there is a lot of volatility and some significant risk that can be held. And although that is still a very lucrative opportunity, what we want to do is, what are the options where we can eliminate the securities risk? And that's where it's strictly from a planning perspective and has nothing to do with investments whatsoever. So it allows these institutions that we refer to invest in these flow-through shares, but then immediately have a second party come in and buy those securities off the investor at a discount so that they have incentive to actually buy the security. But then the investor also has an incentive because it caps the amount of loss or risk on that security and allows the tax planning to take shape and to get full advantage of. So I'm going to walk through a couple of those numbers. We are going to do this based on a Saskatchewan client. That's our kind of home-based province. Obviously, this is available throughout Canada in different jurisdictions. Each individual deal and each individual offering is always going to be unique. But for an example, this is how one of the scenarios for this strategy would work. So this particular one, it's pretty lucrative. Like, we're talking 72.5% is the net return on your cash outlay within this strategy. And there is no securities risk. It's all planning and all through tax credits and tax benefits. If you don't continue, because what happens is there's recapturing this the following year. If you don't flow this back into the same type of strategy, there's recapturing, and it ends up being still a net of 49% in Saskatchewan, which means if you take money out of a corporation, RRSP, or you're at the highest tax bracket, that money is taxed at 48% in Saskatchewan, which means it completely wipes out the tax on, well, actually gives you a little incentive. You get a 1% bonus, but it completely wipes out the income tax on that transaction. Now, granted, you have to have a significant amount of liquidity. We'll cover that. And you also have to be an accredited investor. So you have to qualify as an accredited investor to take part in this planning strategy. So, but there's no securities risk. You're not buying a security through our firm. You're simply buying the security direct from the issuer, which is set up through a lawyer and through a tax firm. And then what they do is the secondary liquidity event comes in immediately after, usually 3 to 5 days after the actual purchase, and they buy it at that discount. So I'm going to run through some numbers. I'm going to wipe this out. Give me some space here. All right. And bear with me here. So the total flow-through share purchase for an investor is, we're going to say that it's $235,198.81. Exact numbers. What you're going to do is you are going to have, that's going to invest in that flow-through share, like I said, for 3 to 5 business days, set up by the issuer, set up by the lawyer, that transaction. Then the secondary cash proceeds from the liquidity provider, this is that secondary market, is going to give you back $162,214.44. So now the firm that facilitates this transaction, the legal fees, etc., there's no free lunch out there. They charge $27,015.88. So it's no joke. It's real significant business. However, when you see it all come together, you'll understand that this is a drop in the bucket. So your net cash outlay is going to be $100,025. So pretty much $100,000. You get federal savings, and I'm not going to write these, too detailed, but you're going to get federal savings of $54,000. You're going to get provincial savings of $23,000, and there's change there, K. You're going to get a tax credit because this initial flow-through share is going to be investing in the critical mineral space. There's additional government credits for suitable investments and for qualified investments. That is going to be $49,000 of credits and change, and there's going to be another additional $70,000, and the capital gains tax on selling the initial investment is going to be $38,525. Which leads a net tax savings, if you add all of this up, of $172,000. Well, let's just round it up. $172,000. So now, that's paying fees, paying the capital gains tax on the sale of that security, which has a adjusted cost base of 0 once you make this transaction. $172,000 comes back to you in the form of tax advantages on $100,000 of net cash outlay. So your net result, because you got the $162K back from your initial purchase, you actually get $72,000 of growth. It's not growth. Sorry, that's the wrong word. You get $72,000 of opportunity of increase in your wealth by doing this strategic tax planning. It's not from the securities themselves. It's not from, selling it at a gain or having any type of potential securities growth or investment growth, but it is a pure increase in your wealth from your tax position because of this strategy. And, we've done this for many, many clients. It's very, very lucrative for accredited investors that have significant liquidity, because let's face it, this is not chump change. But the minimum amount is going to be in that 25 to 50 range, depending on the deal, of net cash outlay. So you want to make sure that you have a significant need here. So let's talk about some of the advantages on where you would use this. We talk about getting money out of a corporation, especially when you consider that the income tax is going to be $48,000, but you're going to get $49,000, 49% net benefit, 72% in the first year. Is, that's a no-brainer. Getting money out of an RSP, like taking additional money out of registered accounts so that you can save on future taxation, because again, it wipes out the tax completely. Possibly the sale of rental properties or a business asset where you have a significant capital gain, plus you have the added liquidity, and you have all of these cash resources where you can utilize to put forth to this type of strategy. You also could have it where you're taking the commuted value of a pension, and there's a significant amount of cash that's coming to you that's not able to be sheltered in registered accounts. This would be a great strategy. Once again, you have to be accredited, which means you need $200,000 of income, $300,000 of family income, or $1 million of investable assets outside of real estate and business assets, or $5 million of business assets will help you qualify as an accredited investor. But I utilize this strategy personally. It significantly reduces my tax position. You have to have, a significant amount of liquidity to go through this. But, within a few short months, it's pretty hard to find any type of strategy that's really going to give you that certain return of 72%, and 49% even if you don't roll it back into this strategy again in subsequent years. It is different from province to province. It isn't as lucrative as it is in Saskatchewan because most of these are local deals that we're talking about. But for the most part, reach out to us, ask questions. What we do is for everyone that inquires, we would set the stage of making sure this is on your radar so that when a particular deal and opportunity comes, that we can introduce you to this system and calculate exactly what the benefits would be, and then also help you understand, okay, what are the cash flow needs, what are the contracts, what is all involved to facilitate this. Many of you might ask, you say, okay, well, what's the risk here? The real only significant risk is that the actual flow-through share company that you invest in, where you get the credits, does not invest 100% of the capital into exploration that qualifies for those expenses. Now, there's disclosure and disclaimers and everything else that suggests that that's really impossible because they're not raising money for nothing. But at the end of the day, it is really, really crucial to understand that. The worst case scenario, if that ever were to happen, is that you'd get a lower return. But that's where we carefully make sure that the sequence of events is proper so that you're actually, for an example, you're taking the money out of your corporation as a shareholder loan so that if need be, if it's not 100% calculated, you can put it back and repay that shareholder loan and you're not stuck with the tax consequences. So again, there's certain circumstances. Everybody's unique situation is different. So we always invite you to reach out to our team and we'll work through the exact math. Every one of our clients that go through this, we give you the exact tax summary so that we make sure that you do not fall in what is called alternative minimum tax. Just because you make $250,000 and have ample cash, you can't write off your income to zero. So there is an alternative minimum. What's nice is the federal government graciously, this doesn't happen often, has increased it significantly from the 40,000 range up to about 160,000 in 2023, and then higher even than that in 2024. So it's allowing a lot more people to take advantage of these types of strategies. So once again, if you have questions, reach out to us. We're happy to show you kind of the synopsis, see if it's something that's suitable for you. It is not for everybody, but for high net worth people, high income earners, and accredited investors that want to, take a look at how they can reduce their tax position and have the experience and the fortitude to look at a strategy like this, we welcome you to reach out and happy to go through the details. So hopefully you got a little value out of this. If you have any questions, let us know. We'll talk soon.